So welcome. We are talking about organizational types tonight and like different things that you might need to think through as you're beginning to set up your business. Um, just going to introduce Jen Suferling, and she can tell you a little bit about what she does here at the bank.
So good evening. So I am, as Mary said, Jen Superling. I work in the cash management department at Chelsea Groton. So my role is working with businesses of all sizes on their account type structure, on finding products that can help streamline their cash flow. But I also am very passionate about our small businesses. I love watching them grow. I love helping them. So collaborating with Miria is great. We get to provide this educational piece to that. But here in the business banking department, we're always willing to be there for you if you have any questions, or if you want some specific things answered about cash flow accounts. I know Alexa gone over it last week, but if you need any more detail, we're always here for you.
Awesome. Thanks, Jen. So we're going to launch right in. We'll move on. So here's our agenda. Welcome. I welcomed everybody. We're going to discuss the concepts. We're going to have a couple of different conversational activities, and we're going to basically learn to identify the general characteristics, advantages, and disadvantages of each different organizational type for a small business. So what are they? There are really 5 common organizational types. They're also called legal structures. And so if you hear that term thrown around while you're filling out paperwork, if you hear legal structure, that's your organizational type. So the first one is sole proprietorship. Then there's a partnership. And that comes in general, limited, and LLP. There's a limited liability company, an LLC, which is what a lot of people are really familiar with. There's a C corporation and an S corporation. So, what are you thinking about as you're choosing? What is going to help you choose the right thing? So taxation is the first thing that you should be thinking about. Taxes on profits are paid through the personal tax returns, except for corporations. So a legal structure determines how your business is set up to be taxed. And the 4 most common ones, the sole proprietorship, the partnership, the LLC, and the S Corp, the entity does not pay, the business as an entity does not pay taxes. Profits from their losses and from the business pass through to the owners and are reflected on your personal tax returns of the owner. So as you're thinking about that, we should also be thinking about liability and risk. So responsibility for harm to another person or property, or contract disputes. So those things can be liability like a personal property, or contractual liability. So those things you need to be thinking through. We'll talk about each one as we're talking about what each structure provides. And then management.
So one of the things I read about, for example, an LLC, is that you want to keep the personal and the business part totally apart.
Yes.
And now you're saying that taxation then goes through the personal tax return. So that's where then you are connected with the LLC.
Yes. So personal and business should be kept far apart. Any of these, right? It is especially important for an LLC, and when we get to that slide, I'll talk about why. Yes. So because like anything else, you as an income earner are going to, oops, sorry. You as an income earner are going to be paying taxation, right? So the business as an entity is not paying taxes.
Okay.
So the profits and losses from the business are passing through to the owners, and they're reflected on their personal tax returns. So it is depends on how you set it up. So only C corporations as a business entity pay taxes, because just because of the way that they're set up. But this is really why you need a tax person, because business taxes are very crazy. So, and I'm not a tax professional, so I can tell you like how it works, and I can't tell you why it works that way, or how best to do it. But definitely, that is one thing to consider. So management you need to consider, because each of the different organizational types has a different management structure, which we'll go over which one of those are. So you need to think about which one of those makes the most sense for you. Then there's continuity and transferability. So that refers to how a business lives the life of the business, and then how it's sold to new ownership. So like how you do it, and then how you're going to turn that over. So some businesses may not be getting sold, but sometimes selling your business might be your exit plan, right? That might be your retirement plan, is that you're going to sell the business. Maybe your retirement plan is the business, in which case you wouldn't really need to worry about that. But you need to figure out how to get out once you're in. And then the last one is kind of expense and formality. So there are costs, there is legal responsibility, and there's a degree of complexity. And all of that differs between different types of businesses. All right, so I'm going to skip this one for now, as we're talking about the different organizational structures. So the first one we're going to talk about is sole proprietors. So that is the one where the business is the one, and the business is one, and the owner, they have the same owner. The business and the owner are the same. So you might have seen like, somebody have their business and then maybe it's their name, right? So a lot of maybe bookkeepers or accountants might do that. Their business is them. So they just set their business name up under, Sue Smith or whatever, because they're the sole proprietor. You can also, when you file, the owner has unlimited personal liability because you are your business. So there's nothing that differentiates between you from the business. Pass-through taxes is personal tax return, and the owner controls the business, which is great. But let's see here. It is the simplest form of organization. If you want to be a sole proprietor, you can like literally just fill out some paperwork and send it into the state. It's very low cost, and it's appropriate for a small startup. The taxation thing, a sole proprietorship has pass-through taxation. So that means the business itself does not file a return. The income, so the loss, passes through and is reported on the owner's personal tax return. Sole proprietors often need to make quarterly estimated tax payments. And this is why, as a business owner, you really, really, really do need a tax accountant, a CPA, somebody telling you what you should be doing, reminding you when you should be doing it, because the taxes for a business, because they're generally so much higher than regular personal taxes, it gets confusing. There's tons of write-offs to make it all work out in the end. So you just really need somebody to tell you what you're supposed to be doing. You can manage most of the risk for this type of business with insurance and really good contracts. So as long as you have maybe worked with an attorney to get a really good contract for your business and have worked with your insurance provider and are very clear about what the services that you're providing are and thinking through what the risks on those services are, you should be able to mitigate most of your risk for this type of business with insurance and like good contracting. You are the manager of this. It belongs to you. You assume full risk for the business. This sole proprietorship lasts as long as you're alive and until you sell it. So you can sell a sole proprietorship to somebody else, and you can also transfer it to another family member. So, you know, if you're looking at this being a family business and you're looking at trading it to a child or, you know, a nephew or, you know, your second cousin, fourth removed, whatever it is, usually you can do that through the estate planning process. So you really need to be talking with your financial advisors and things like that. The sole proprietor, it's really simple way of doing business to create the sole proprietorship. It's very low cost, and it is an appropriate form for most startup businesses. Okay, are there any, knowing that I cannot answer any tax questions, are there any questions about the sole proprietorship? No. Okay. So the next one is a general partnership. So that, you know, is a business or association of two or more people. So, you know, maybe you and your friend, or you and your wife, or you and your nephew decide you're going into business together. Maybe it's you and just some guy you met at a networking event, decide that, you know, your skills work great together, and you decide you're going to go into business together. That is a general partnership. There are also advantages and disadvantages to a general partnership. Owners have personal liability. There is, again, pass-through taxation. There is shared risks and costs, though. It's a simple form, it's low cost, but you absolutely need to create that partnership agreement. So like a sole proprietorship, the partnership is a tax reporting entity, not a tax paying entity. So you're reporting your taxes, but the company itself, the business isn't paying the taxes. The people that own the business are paying the taxes. So the partnership must file an annual information return with the U.S. Internal Revenue Service to report income and losses through operations, but it does not pay federal income tax. So there's no like specific tax form for this. You as the business owners are sorting all of that out with your tax person. And again, you can do that. And when we can get to our tax person, he has talked in the past about how you can choose to file as an S corp, and but I will leave that up to him to talk about. So there are ways around filing for yourself. You just have to file differently. But each partner includes his or her share of the partnership income or loss and on their tax return. So the owners of the general partnership have a unlimited personal liability because, again, you are the business. There is nothing between you and the business. You're your business. You're jointly liable for the partnership's obligations. And so that means you can each be held personally liable for the entire amount of an obligation in the partnership. Insurance, again, and really great attorney drawn up contracts can mitigate most of the risk for a general partnership. Generally, the partners have equal management rights unless there is something else that you want to do. Your management rights can be whatever you want them to be. So, for example, if you and your partner, you're the brains behind the business and you want to do it, and they're taking care of maybe the bookkeeping end of it. Maybe you partnered with a tax person, and they're going to handle all of that. They're a CPA, they're going to handle all the finances for the business. Maybe they only have 20% of the business, and maybe you have 80% of the business, but your partnership agreement will spell all of that out. So if you have a partner, you have to have a partnership agreement. And the partnership agreement, if you have a partnership, needs to be on file with the bank. So they're going to request that document when you go to open your business account. And so you need to kind of get all of that figured out before you file for a general partnership. They are similar to sole proprietorships in expense. It's pretty low. But partnership agreement that you need to figure out, which they're going to ask for, need to say like the capital contributions. Like when we start this business, there's two of us. So partner A contributed X amount of dollars and partner B contributed X amount of dollars. Distribution of profits. If you are a 50-50 split, then 50-50% of the profits. If you're an 80-20 split, it's 80% and 20%. You just need to figure out what that looks like. Who's in charge of the management of the business? Are you both equally responsible for it? Is somebody on the day-to-day management? Who's doing the bookkeeping? Who's doing the banking? And who can terminate the business? So do you need both partners to agree to terminate the business, or can the 80% share partner terminate the business on their own? So those are all the things that it's going to ask you to spell out in a partnership agreement that you are going to have to provide to everybody when you file for a general partnership. Does anybody have any questions about general partnership? Knowing that I can't answer any tax questions. Okay, I don't know that anybody on this call is going to have a general partnership. This one is usually everybody's favorite. It's the limited partnerships and limited liability partnerships. And then LLC, limit liability individual, is on the next slide. So if you want to be a partnership and you want to be a limited partnership or a limited liability partnership, there for two more people, I don't think anybody on the call this qualifies for. Not every place allows like a lawyer or an accountant to be this. So you have to just check with your area. General and limited partners, the general partner runs the business. There's again the pass-through taxation, requires the partnership agreement, and the liability will depend on the type of partner. So if it's general or limited. A general partner has unlimited personal liability, meaning that, you know, if you both are 50-50, if you're 60-40, but limited partners, like if you don't have control, then like maybe you're only the financer, and so you're only listed as a partner in that aspect. They're only personally responsible, liable up to their personal investment in the partnership. So if you're 50-50, then you're both equally responsible. If you're 80-20, one person's 80% responsible and the other person is 20% responsible. The limited partner, if you're an 80-20, the limited partner can't be there the same amount of time as the person that is the general partner. The limited partner has to be there a limited amount of time. So it can't be an equal partnership, but filed as a general partnership. So just know that. Again, The partnership agreement needs to spell out how you can exit this plan. And this particular one requires a filing with the state. A limited partnership will also be required to include LP as part of its name. And so this one is a little bit more, takes a little bit more legwork. But again, I don't know that we have any partnerships on the call. But an LLC, and everybody would like to form an LLC. They're an unincorporated hybrid entity with traits of a corporation and general partnership, or the sole proprietor. Okay. There are advantages and disadvantages. There's greater flexibility than a sole proprietorship and partnership in distributing the profits. And it's also less restrictive than an S corporation, which we'll talk about what that is in a couple more slides. There's limited liability like the corporation. There is pass-through taxation like a sole proprietorship or a partnership. So an LLC is considered to be similar to a corporation in that the owners have limited personal liability to the debts and actions of the LLC. So an LLC means that you have limited liability. So there, and there was a question asked earlier on, do we keep it separate? Well, everything should always be kept separate. Finances, you should have a business email separate from your personal email. Owners of an LLC, if you're a single owner or a double owner, you're called members of the LLC instead of owners of the company. Members can be individuals, they can be corporations or other LLCs. You have to file articles of organization. This one is, again, a little bit more, it takes a little bit more to file this. You might need an attorney to help you file this. You can file it on your own. All the paperwork is out there, but it does take a little bit more. So it's usually you file with the Secretary of the State, you pay your filing fee and create an LLC operating agreement. If you are a sole owner of an LLC, if that's just you, then you know everything's you. If it's a joint, which it can be, you just again have to have that operating agreement, sets out the rights and responsibilities of each of the LLC members. The taxation is, again, like a sole proprietorship or a partnership. It's not considered separate from its owners for the tax purposes, only for liability purposes. It's called the pass-through entity. Business income passes through the business to the LLC members who report their share of the profits. Their losses or their profits or losses on the individual tax returns. Like the owners of a corporation, they are protected from personal liability, meaning if something goes wrong, if you bake something, make something, do something that harms somebody else, the business is what can be sued, and the LLC protects the individual members from being personally liable. Now, what has a tendency to happen sometimes, and this is why you have to be really careful with an LLC, is because everything has to be separate. You cannot intermingle anything at all. If, for example, you use your personal email to email a client, it's called what they call piercing the veil, meaning that you have opened the door to them having direct access to you, the member of the LLC. So everything has to be through the business side. You have to be When you have an LLC, you have to be very, very careful to make sure that you're not piercing that veil. No money can accidentally be going to your account. You cannot commingle funds. You cannot use personal emails. Everything has to be on a business side. So it's really important that you have everything together when you're ready to file your LLC.
Does that include like equipment as well? Like, do you have to have a separate computer, or can you be working on a personal computer as long as you're keeping the accounts separate?
I am not an attorney, so that would definitely be a question that would be great to ask an attorney, or a tax accountant would probably know the answer to that, because they watch those things all of the time. I would say that, I mean, if you wanted to be sure that nothing ever commingled, that, you know, you were using certain devices for your home things and certain devices for your work things, it's really why a lot of companies do not like you accessing your personal email from their work computers, because it really opens up the door to them in a lawsuit of you having access to outside, you know, commingling your work plus your personal, so that it just opens weird amounts of doors. So that's not something that I would not be able to answer that question. I can find out for you. I can dash off an email to an attorney friend of mine and see if I can get an answer for you, though, Katie. So the other one is a corporation. So there's two kinds of corporations. There's a C corporation and an S corporation. A corporation is basically a legal entity that's created under the laws of the state, which has its own privileges and liabilities distinct from those of its members. So there's a C Corp and an S Corp. So they are more complex business structures. There's also like administrative fees to create and maintain a corporation. So like there are things that you have to file every year for all of these, but more so for the C Corp and the S Corp. Filing for them both is very similar. You have to file an article of incorporation with your Secretary of State. With some states, your state's they might have a corporation division. Connecticut does not. So it's just with the Secretary of State. The articles of incorporation usually cost no more than a couple $100 in fees. You really want to make sure that those are tight. It's probably not something that you want to Google and throw together, because chances of you making a mistake in filing and then having there be some kind of loophole later, that's never really a great idea. You have to establish a company name, a purpose. Corporations can be publicly traded. So if you are doing a stock quantity and price, you have to have a resident agent name and address, meaning there has to be an owner of that corporation. Somebody has to be on file somewhere, and corporate officers' names and addresses. So like the board members, corporations have to have boards. So only after the articles of incorporation are filed and accepted by your state does the corporation acquire legal existence. So for the others, you can kind of operate until they approve all of your stuff. The corporation, no, you're not in existence at all until everything is filed and approved. The board of directors appoints officers who conduct the business of the corporation. So corporate ownership is much more complex because it has a legal identity that's separate from its owners. So like the corporation is a thing, like Apple is the corporation, right? it has employees, it has board members, it has all of those things, and Apple is the corporation. If you're looking at small businesses, you know, Sift Bake Shop, not a corporation, right? I don't think. Shareholders typically have various rights, including the right to do the following: elect directors, receive information, inspect corporate records, vote on fundamental business decisions such as mergers and liquidations, and share and dividend distributions. They do not have to. All of that has to be spelled out. Like, you are going to have to spell out all those things. Most of the businesses on this call, most of the businesses that we know do not have to incorporate. You don't have to be a corporation. But you can file as a corporation, but you need to talk to a tax attorney on how to do that. The C corporation is called a regular corporation and is the most common kind. It's limited liability, again, because the corporation is separate from the owners of the business. The company itself is taxed versus the individual. The owners pay individual income tax on money they receive from the corporation as a salary, a bonus, dividends, and then double taxation can be an issue with C corporations, since the profits taxed at a corporate level are taxed a second time at the personal level as the dividends. And I am only reading that in my notes, and I cannot explain all of that to you. I'm just telling you, it is common that there are double taxation issues. So that is something that if you think that you might want to file as a C corporation, that you would want to talk to a tax professional about before you decide that this type of thing is for you. They are very complex to form. There is so much paperwork that you have to file. The ownership is complex because you have owners, you've got board members, you've got all of these moving parts, and is really only appropriate for a few specific reasons. Otherwise, you're probably going to choose a different organizational type. For most of the small businesses that would be on this call, it would be a partnership, it would be a single entity, it would be some kind of an LLC. An S Corp, the owner has limited liability of a corporate shareholder, but pays income tax like a sole proprietor or a partner. It's the same as a C corporation, except for the pass-through taxation. So the major difference is all business profits on an S Corp pass through to the owners who report them on their personal tax returns, like the same as with the sole proprietorships, partnerships, and LLCs. The S Corp itself does not pay any income tax, although the S Corp with more than one owner must file an informational tax return. So like a lot of businesses, maybe some nonprofits might be set up as corporations because the people change, the board changes and things like that. Most small businesses do not need to be set up that way. You might need to grow into a corporation. You might grow as you get bigger, but most businesses never really need to be a corporation. Any questions? I don't know that anybody on this call wants to be a corporation. All right. So how and why would you decide to choose, you know, what kind of organizational structure that you would have? So you're going to work on establishing your business plan and think about your business, because choosing what type of business, how you're going to file before you have your business plan written, is very much like saying, you know, I am going to be a tax accountant before I've even gone through high school and I even know what any of my career options are. Like, you don't know what your path is going to look like. So you need to get your business plan together, at least be on a good path about it, so that you can think through what you want your business to look like. So as you're thinking through, what do I want my business to look like? That's really going to help you choose, do you want to be a sole proprietor or do you think you want to be an LLC? So, those things will help you choose. You need to think about like the structure of the business. Are you going to be an owner operator? Is there going to be a partnership? Are there going to be multiple owners? Are you going to have a product with significant liability? So you need to think about that. Like, if you were going to be a fireworks manufacturer, you are definitely probably not going to want to be a sole proprietor, because you would be personally liable for all of that. And no matter what kind of insurance you took out or what kind of contracts you had, they could be watertight, but people are going to sue you anyway. You're going to spend so much time because some kid blew off their hand, like fighting these battles in court, that it's just not going to be worthwhile, right? So it's thinking about, does my product have significant liability? Meat packing plants, like things like that. What happens if, I'm going to be a farmer and I take my lettuce to the farmer's market and all of a sudden, my lettuce has salmonella. Is that going to be a problem? Like, how do I want to look at that? A large venture with multiple owners and complex financing. That could be, you might want to, obviously you wouldn't be a sole proprietor in that case. Complex financing might need that you might want to be a partnership or an LLP, a limited liability partnership. What is that financing going to look like? Who's going to be responsible for it? What is each person's stake in the business? So all kinds of different things. You definitely, unless you're going to be a sole proprietor, if you have just one thing, right? If I'm going to be grinding cornmeal and making cornmeal, and that is my business, like it's just me and I'm growing corn and I'm grinding it and I'm making cornmeal, I probably might want to be a sole proprietor, unless I want to be an LLC in case, something else happens. You might want to consult an attorney if you're concerned about maybe what your liability might be. Attorneys that are well-versed in helping small businesses start are going to be a really good guide for you, because they've processed so many applications. They've seen so many things go through. They can help you think through what might go potentially wrong with anything. So, definitely ask an attorney. You can research through the Small Business Administration and the IRS websites, look through, see what it says, see if that makes sense for you. But you need to really be thinking through, what is my business? What type of liability? How many people are going to be involved in it? And that is really going to set the tone for you, to help you choose which one of these particular organizational types you would want to choose. All right, so let's pause right here. And the organization type impacts how you own and run your business. So you definitely want to make sure when you're choosing your organization type that you choose the one that is right for you. As it's been indicated on this call, it's a lot easier to change from a sole proprietorship to an LLC or something with a little bit more, teeth to it than it is to try and scale back. If you registered your business as a corporation because you you want it to be completely separate, and you thinking you're going to have a board and all this other stuff, and then you want to scale back, that's going to be a little bit more complicated than trying to scale up. It's always easier to go up than it is to come back down. You're going to want to match your legal structure to your business needs, like tax, liability management, continuity, and expense. So when we can get the tax attorney to come and speak, Ed Munzner usually teaches all of our tax classes. He is a professor at Three Rivers. He has his own CPA firm. But he does a really great job in clarifying how the taxes are filed, how you can file your taxes so that you're minimizing your risk and making sure. He is an excellent speaker. So the most common small business type is the sole proprietorship. The person and the owner of the business and the business are basically the same. You can file, as Katie did, as a DBA. You just go right down to, your city hall, your town hall, whatever it is, and say, I would like to do a DBA and do as a sole proprietorship. If you want to claim your business name, you might want to do that on the state's website. Just file paperwork to claim it. And a partnership includes pass-through taxation and personal liability. So a partnership does not mean that you're any less liable. It means more people are kind of liable, and maybe you're spreading the liability out amongst more people. And the business plan is the best way to determine the organizational structure that's right for your business. I talk a lot about business plans. They're really important. It really is kind of the roadmap to your business. It's going to help you decide where you want to go, and knowing where you want to go is going to really help you choose your organizational structure. Again, you can kind of change your organizational structure as your organization grows, but choosing a structure that is too big for you when you start out is really unwieldy and will probably create you more headaches and stress than you would ever really need. All right, so with that, do we have any questions?